Okay, here we are. How you doing, everybody? Good. Let's kind of reiterate where we are right now. We're on the receivables chapter. We're continuing to talk about the allowance method for accounting for bad debt expense. Now, we said that there was two main methods for accounting for bad debt expense. There was the direct write-off method, right? And then there's the allowance method, right? The problem with the direct write-off method is that it violates GAAP because it doesn't follow the matching principle, correct? So we started learning the allowance methods last lecture. So if you need a refresher on that, watch the previous lecture. But we talked about the percentage of sales method and the percentage of accounts receivable method, correct? So let's go ahead and go over the problem 9.3a, okay? I think that was the only one I assigned, correct? So let's take a look at problem 9.3a, all right? And that is on page 385, okay? Now, as a refresher, we know that the journal entry to estimate bad debt expense under the allowance methods is always going to be a debit to bad debt expense and a credit to allowance for doubtful accounts, correct? We know that that is the account debited. We know that that is the account credited. These different methods, the percentage of sales, the percentage of accounts receivable under the allowance methods, these are just different ways to calculate the estimated number that will go in the blank, right? But the journal entry in regards to what is debited and credited remains the same, right? Okay. So let's go ahead and take a look at this. Problem 9.3a. At December 31, 2011, Ethan Company reports the following results for its calendar year. They give us the cash sales and they give us the credit sales, right? In addition, its unadjusted trial balance includes the following items. They give us that accounts receivable is a $1,070,100 debit balance, and allowance for doubtful accounts has a $15,750 debit, okay? All right, prepare the adjusting entry for this company to recognize bad debts under each of the following independent assumptions. Okay, what if they say that, what if the way that they're going to go is that bad debt expense is estimated to be 2% of credit sales, right? 2% of credit sales. Now this is a percent of sales method. Sales, simple. You don't have to do the T account, do you? Okay, so let's take a look at how this would look. All right. Okay, we know that the journal entry bad debt expense, credit allowance for doubtful accounts, correct? We know that that's the entry. We just need to know what goes in the blank, correct? So here we just take 2% times credit sales, which is 3.534 million, is that right? And that equals, let me do that in my head real quick, 7680, is that right? And boom, that's what goes in the blank. So that is the entry for 1A, right? Can you see that back there all right? Questions? Okay, let's go ahead and go on to 1B. Okay, 1B, bad debts are estimated to be 1% of total sales. Okay, well, we're under the allowance method, so again, we know that the debit is to bad debt expense, and the credit is to allowance for doubtful accounts. So we just need to know what number goes in that blank, right? This is 1% of total sales. Now, they told us cash sales are 1,803,750, and that credit sales are 3.534 million, right? So total sales are what? What do total sales equal? Anybody add that up?
5,350,500.
Is it 5,337,800? Is that right?
Oh yeah, yeah.
Okay, 5,337,800 is total sales, correct? And it's just those two numbers, cash sales and credit sales added. And then we take that times 1%, right? And that equals 5,337,800.
It's 750, not 800.
At the end, 5,337,750.
And so then the total 1% of that is 53,000.
I screwed up, huh? Okay. That's what happens when I try to do things in my head. Okay. Let's back up. Sorry about that. Let's go back. Thank you for pointing that out. I always appreciate when you guys do that. Let's just do this the right way. Cash sales equal 1,803,750. Is that correct? Credit sales equals 3,534. Okay, now let's just add that up, and that will be total sales, correct? So that equals 750, 7,335. Is that right? Okay, so that's total sales. That's 5,337,750. Okay? So now we take that times 1%, right? And what does that equal? Of course, they rounded is what you're saying, right? That was where I got in trouble. They went ahead and rounded that to 5,338. Okay? Now, if you wanted to go 5,337.50, that's fine. I don't care. Okay? They went ahead and rounded. So if you're off by 50 cents or a dollar, no biggie. But that's the number that goes in that blank. We don't have to do the T account because this is a percentage of sales method. You with me? Sorry about that confusion. Okay. Any questions on 1A or 1B? Those were the percentage of sales methods. We didn't have to do the T account analysis, but 1C, we have to, don't we? Because that is an aging analysis estimates that 5% of year-end AR will be uncollectible, correct? So, let's do 1C. 1C. 5% times your AR of 1,070,100, correct? And what does that equal? What's 5% of that number? 53,505? Okay. Okay. That is our desired ending balance. Correct? Okay, so now we have to do a T account for allowance. This number that we just calculated, that's what we want to be right here, right? 53,505. Correct? However, we have a beginning balance in there, don't we? What's our beginning balance of allowance for doubtful accounts?
15,750.
5,750 debit balance, right? Okay. So, what do we have to do to bring the existing beginning balance of 15,750 to the desired ending balance of 53,505? What's that number? 69,255. Okay. So, that is the number That is the number that goes in our journal entry. And of course, we know the journal entry is a debit to bad debt expense and a credit to allowance for doubtful accounts. So that's our entry right there, correct? All right. The percentage of receivable method is when you have to do that T account analysis, right? Okay, cool. Now I wanted you to skip requirement number 2 and do requirement number 3, correct? So let's do that. Show how accounts receivable and the allowance for doubtful accounts appears on the December 31, 2011 balance sheet, given the facts in part 1C. Okay, and that's the part we just did, right? So the way that that would look is okay, this would be in the current asset section, correct? And we would just have, let me back that up a little bit. We would have accounts receivable of that amount right there, right? Less the allowance for doubtful accounts of, what is the ending balance of allowance for doubtful accounts? It's right here, isn't it? 53,505, correct? It's not the entry we made to it, it's the ending balance, correct? Whenever we do balance sheets, we're always pulling the ending balance. So the allowance for doubtful accounts ending balance is 53,505. I'll put brackets around that to indicate that it's subtracted. And then that equals 1,016,595. And we can call that net AR. Now I like to ask this right here, because I've said this before, but I'll say it again. If people don't know what types of accounts an individual account is, or what its normal balance is, or what financial statement it goes on, or how it looks on that balance sheet, or on that financial statement, then I don't feel like they really know what they're doing, okay? Remind me, what type of account is allowance for doubtful accounts? Contra asset with a credit balance. It goes on the balance sheet. This is how it looks on the balance sheet. Correct? All right. That was it for homework, wasn't it? Okay. Good. Okay, what I want to do now is talk a little bit as far as what the next part of this chapter is. Now, we have been talking about the allowance method, and we've been talking about how you estimate bad debt expense, correct? Now, I want to talk about, we talked about the percentage of sales method and the percentage of AR method, okay? Now, I do want to talk about and mention the aging of accounts receivable method, okay? The aging of accounts receivable method, okay? Now, here's the rationale behind the aging of accounts receivable method, okay? So coming off the PowerPoint, Jessica, let's say your company owed my company $10,000, okay? And let's say your company also owed my company $10,000, Jake, okay? Now, let's say your account is 28 days old, right? Let's say your account is 174 days old, okay? Now, they both owe me $10,000, did I say $10,000, right? Who is obviously less likely to pay me? This guy. The older an account is, the less likely you're going to collect it. Has anybody ever looked at an aging of accounts receivable? What an aging looks like is it doesn't just list your customers and how much they owe you. It also lists how old those accounts are. Okay? When I go into my clients, I always ask for an aging. And the accounts that are like more than 90 days old, that means that they've gone 90 days past when the product, excuse me, or service was provided and they still haven't paid. Those are the ones I look at pretty closely. I've seen clients with accounts receivables that were 1.5 years, 2 years old. And I'm like, hey, Mr. Client, this probably is not going to be collected. We need to get it off the books. Your assets are overstated, okay? But the aging method that we're going to look at recognizes that, hey, we can't just take a percent times a total of AR. We have to analyze the how old this is, because these are obviously the same amounts, right? But the chance of collectability is a lot less on Jake's, correct? So here's what they do. They group each receivable by how long it is past due, and then they take each age group multiplied by a bad debt percentage. And obviously the older accounts, there is an increased chance of non-collection. Okay, and then we total those up. Let's take a look. Here is an example of an aging of accounts receivable. Now, with just a percent of AR method, we would just take a percentage. Let me get my pointer. With the percent of AR method, we would just take a percentage times this number right here, right? The aging of accounts receivable method says, no, we want to break these out into categories. Now, this amount that isn't even due yet, the percent uncollectible is only estimated to be 1%. 3% for those that are 1 to 30 days past. And the older they get, the percent uncollectible is higher. This one that's over 90 days past due, they said that there's a 60% chance it's uncollectible. So you take these amounts times that, and you get the estimated uncollectible amount. And the total of that then is 5320. Okay? Now we're not done, but before we go on to this slide, do you see what we did here? You see what we did? Okay. Then we take that 5320, which is the total there at the bottom right, and that is the amount we want to be the ending balance. Okay? See it right here? Now we still have a beginning balance to deal with of 900, so our entry is for 4420. You with me? Okay. Now, I will tell you, I see the percent of AR method used a lot more in practice than I do the percent of aging. But a lot of times we'll go into some clients and, analyze it a little closer, and we'll use these sort of techniques. Really look at how old accounts are. Does that make sense? Okay. Questions?
So that's not something that every company would necessarily have already made up?
Okay,
like a list of aging accounts, but they would have possibly the percentage of accounts.
Good question. And what she's asking, is that something that every company would have? Well, first of all, let me back up a little bit. Companies are going to choose whatever method they want to use for allowance. They could use percentage of sales, they could use the percentage of AR, or they could use their percentage of aging. However, most companies have an aging, which is an accounts receivable detail listed by how old accounts are. Okay? I mean, because here's the deal. Almost all companies have some sort of accounting software that they utilize. And an aging of accounts receivable is such an expected report. No accounting software would not have that option to print off your aging. You see what I'm saying? So it would, it's an extremely common report. So you could generate that report. I've never been to a client that used accounting software that they could not generate that report for me. Now, I have had clients who have. You always have to ask yourself, what date is it aged from? Is it aged from an invoice date, or is it aged from a product or service delivery date? You know what I'm saying? I've had companies that have changed their dates. So if something got real old, they changed the date so that it wouldn't look so old, even though it's just as old. Does that make sense? That was bad. Okay? Because here's the deal, is a lot of times this aging of accounts receivable, this is something that the banks want to see. Because a lot of times these accounts receivables act as collateral for the loans. And if the receivables don't look valid, then all of a sudden your collateral doesn't look valid. You see what I'm saying? You can get some problems there. So, accounts receivable it's a really important item on the balance sheet. And when I go into clients, it's something we look at very, very closely. Because it's not cash, but it's the closest thing to cash, isn't it? Or one of them, right? You have to verify the validity of these receivables. You can have a $1 million receivable on your books, but if you and me and the man on the moon all know that it's not going to be collected, it's not worth anything, is it? Okay? So, and I always have my clients try, oh no, it's still collectible. We're going to still, I even told my company, this company has gone out of business. They don't even exist anymore. And they were still trying to tell me it was collectible. I'm like, it's not. But then we have to write it off the books. We take the receivable off the books, and they hate that. They hate that. And their assets go down, their collateral goes down, their ability to obtain loans based on that collateral goes down. Just doesn't look good. And usually somebody gets in trouble for who sold to that company, and they didn't pay. Okay? So, it is an important area. Okay? Now I want to talk about writing off a bad debt. Now, I want you to really focus in on here what I'm saying. We are still using the allowance method. Okay? Before, we were talking about estimating bad debt expense, correct? We were talking about estimating bad debt expense. And when we estimated bad debt expense, we were estimating that some part of accounts receivable would not be collected. But of course, we did not know which customer wouldn't pay. We were just making an estimate, right? Thus, we had to use that allowance account. We couldn't decrease accounts receivable because we wouldn't know where in the customer detail to go, right? Now, this is writing off a bad debt. People get this confused with estimating bad debt. But when we write off a bad debt, we now know of a company that is not going to pay. Maybe we read that they went out of business or something. When we write off an account, it's going to look like this. This is under the allowance method. We determine that Martin's $300 account is uncollectible. So what we do is we debit allowance for doubtful accounts and we credit accounts receivable. Okay? Now, students always want to debit bad debt expense when we write off a bad debt. They want to. But there's no bad debt expense being debited or credited here, right? Why? Because we debited our bad debt expense back when we estimated bad debt expense. This is not estimating bad debt expense. This is simply saying, okay, we now know of an account that is not going to be collected, and we're going to write it off and get it out of our aging or get it out of our receivable listing. Does that make sense? Okay? To summarize, this might be something you want to copy down. These are both under the allowance method. To estimate bad debt expense, we debit bad debt expense and we credit allowance for doubtful accounts. But to write off a specific accounts receivable, we debit allowance for doubtful accounts and we credit AR. Okay? Does that make sense? You with me? Now, I'm going to ask you on tests, I guarantee I'm going to ask you to estimate bad debt expense, and I guarantee I'm also going to somewhere ask you to write off a specific account. People get these confused. If I'm asking you to estimate bad debt expense, or when I do, this is the journal entry. When I ask you to write off a specific account, this is the journal entry. But it never fails. I ask somebody to write off a specific account, and what they do is they think I'm doing the estimate of bad debt expense thing. So they have T accounts, or they always have bad debt expense being debited. It's just hard for students to say, okay, we're now writing off a specific bad debt, and then there's not a bad debt expense being debited here. It's because it was already been done. We don't want to double do it, do we? Okay? You with me? Now, what if, let's go back to what if we write off this account for $300 for Barton, and then guess what happens? He comes in and wants to pay it off. Well, then all we would do is we would make this entry right here to reinstate it. This is just a reversal of the entry we just made, correct? Right? And then we would collect the cash as normal. Are you with me? Make sense? You can see that that top entry is just a reversal of this one, right? Flip-flopped. You with me? Okay, I want to do something in class real quick. Let's go ahead and just take a few minutes while the music rolls, and let's do Quick Study 9.2. Quick Study 9.2. Okay? Quick Study 9.2. I'll see you in about 2 minutes. Okay, if you're not done, folks at home, just pause it. Come back when you're done. Let's take a look here at Quick Study 9.2. Okay? All right. Let's go ahead and read this. Milner Corporation uses the allowance method, right, to account for uncollectibles. On October 31st, it wrote off a $1,000 account of a customer, C. Schaub. On December 9, it receives $200 payment from Schaub. Okay, let's prepare the journal entry when we write that off. When we write that off, it is a debit to allowance for doubtful accounts and a credit to accounts receivable for $1,000, right? You with me? Okay. There's no bad debt expense in that entry, is there? Okay. Now, prepare the entry. Okay, on December 9th, it receives a $200 payment for Schaub. Prepare the journal entry or entries for December 9, assuming no additional money is expected. Okay, so we don't reverse that whole entry, but we do reverse $200 of it. Okay? We reverse $200 of that. Now, if we had a strong belief that the entire $1,000 was going to be collected eventually, even if we didn't get it all now, we would reverse the entire amount. But here we're just saying, okay, we must have some belief that there's going to be $200 collected, and that's all. So we reverse that, and then we show the cash collection of the $200. And again, we do this even though AR is debited here and credited here. We do this because we want to show a record through the AR. Okay? All right? So that's why we do that. Does that make sense for Quick Study 9.2? Okay. No problems there? Once again, I just can't emphasize enough this guy right here. You need to know this. Okay? Under the allowance method, to estimate bad debt expense, that's the journal entry. To write off a specific account, the lower one is the journal entry. You with me? Now, I want to point out something else. Now, we talked about how, or in that one we just did, we wrote off a $1,000 account. Is that correct? Okay. Let's forget the second part of it. Let's focus on when we wrote off that $1,000 account. Okay? Let's take a look, and I want to kind of explain something to you. Let's say we know we have accounts receivable on the books less the allowance for doubtful accounts, correct? And that equals our net AR. We talked about that, right? Well, let's say before the write-off of that account, let's say our accounts receivable was $100,000, and let's say our allowance for doubtful accounts was $6,000. And so our net AR before the write-off was $94,000. Does that make sense? Now, we did the write-off here, right? Let's remind ourselves what the write-off is. The write-off was right here, correct? We debited allowance for doubtful accounts for $1,000 and credited AR for $1,000, right? So we know allowance for doubtful accounts is a credit balance account since it's a contra asset. Thus, when we debit it, it is being decreased, right? We also know AR is a debit balance account. Thus, when it's being credited, it is also being decreased. So now let's see what this would look like after this write-off. What would this look like? Okay. After the write-off. Well, AR decreased by 1,000, right? Correct? Okay. And allowance for doubtful accounts, it also decreased by 1,000, didn't it? Right? So this is now what, $5,000? So what is our net AR? It's still the same. When we write off a specific account, the net AR does not stay the same. Oh, I'm sorry. The net AR does not change. It stays the same. Correct? Make sense? When we write off a specific account, the net accounts receivable does not change. And the reason is, yes, we are reducing the allowance, but we're also reducing the accounts receivable. Or said another way, we're reducing the accounts receivable, but we're also reducing that thing that's subtracted from accounts receivable. Okay? So writing off a specific account, the only thing it really does is we can now say, okay, we now know of a specific account that's not going to be collected. We can go to our detail. Right? Does that make sense? Questions on that? So I wanted to point that out. Let me point out one other thing. Remember how I said whenever we make a debit or credit to accounts receivable, let's say it's for $500, and let's say this is a XYZ company. Remember how I said whenever we make a debit or credit to AR, we have to post this. Well, of course, we have to post this as a debit to AR, right? I'm sorry, a debit to cash. Of course, when we have this journal entry, we have to post this as a debit to cash in the T accounts. But then we have to go to the AR and we have to post this both to the control account and to the subsidiary detail, right? Now, somebody asked me, now, wait a minute, I thought debits were always supposed to equal credits. And it seemed weird to them that we were posting this as a debit to cash and this in two places, to the AR control and the AR subsidiary. Well, debits do always have to equal credits in a journal entry. We just have to post this two places. Okay? And in reality, most of the time, the AR control is simply going to be, a total of your detail. Your control, let me say that again. Your control account's just going to be a total of your subsidiary detail, right? So I don't want there to be confusion. Yes, debits always have to equal credits in a journal entry. It's just that when we have an AR, we have to put that two different places. Does that make sense? Okay, questions? Are we good? All right. We got a little time left. A teacher who didn't love you would let you go early. But I love you guys, so I don't want to shortchange your education. Okay? So let's talk about some of this. Let's sum up things up a little bit. The percentage of sales method has an income statement focus, right? And that makes sense because we're taking the percentage times sales, which is an income statement account. And it kind of its emphasis is on matching that sales to the expense. Now, the percentage of receivable methods, whether it be the percentage of a total receivable or the aging, that has more of a balance sheet focus, where we're really looking at that AR balance, right? Now, all these methods that show up on this slide follow the matching principle. But the percentage of receivables method, it's approaching it from a balance sheet side, which makes sense because receivable is a balance sheet account. Okay? These are all accepted methods under GAAP. All right? I want to switch gears a little bit and look at notes receivable. Okay, now what is the difference? One of the most common questions I get in accounting is, what is the difference between accounts receivable versus notes receivable? Well, accounts receivable is you make a sale to a customer for maybe $700 and they're going to pay you later. And this is usually a customer that you've had for a while. It's kind of like put it on my tab sort of a thing. It's not a real formal deal. There's no interest involved. It's just they're going to pay you later. A note receivable is like this. Does anybody have a car loan here? Nobody in this room has a car loan? Not anymore? Okay. Has anybody ever had a car loan? Okay, thank you. Well, when you had that car loan, Anna, the bank had a note receivable from you. Because a note receivable is two things. It's more formal, It's written down in a note. You probably had to sign a bunch of documents, didn't you? And there was interest involved. So those are the two things that differentiate a note receivable from an account receivable. With a note receivable, it's more formal. It's written down on a note, a bunch of signatures, and there's interest involved. You with me? All right, so let's take a look at how we account for notes receivables. Now, those can spring up in a business. Now, obviously, a bank would have a ton of note receivables. But what about a regular business? Could they just have a non-banking business? Could they have notes receivables? Yes. Well, a note receivable is a promise to pay a specific amount at a specific future date. And like I said, it is more written down and formal. Okay? So, where's my pointer? So, you have at the bottom here, it's signed. You have an interest date or an interest rate. You have the terms of it, correct? You have all these things that are written down and formalized. You would not have this with an accounts receivable. Okay? The term, the payee is the one who will receive the money in the future. The maker of a note receivable is the payor, the one who will be having a cash outlay in the future. Okay, so you should be familiar with those terms. The principal amount is the amount that is the base amount, $1,000. Now the interest rate is stated there, and it's usually always stated per annum, which means an annual interest rate, and then you have the due date on there. Okay. Now, how do we calculate? Let's take a look. Let's actually go back to this note. There's $1,000 is the principal here. But when this person, Julia Brown, pays off this note, is she just going to be giving $1,000 of cash? No. That's the principal she has to repay, but she also has to repay some some interest. She has to pay back the principal of $1,000 plus some interest. How much interest does she pay back? Well, this is our interest computation. I don't think we've ever gone through this before, have we? You'll see this a lot. You're going to take the principal of the note times the annual interest rate times the time expressed in years. And that's how much interest has to be repaid. It's best kind of to look at an example, so let's do that. On March 2012, Matrix Inc. purchased a copier for $12,000 from Office Supplies Inc. Matrix gave Office Supplies a 9% note due in 90 days in payment for the copier. What's the maturity date of the note? Well, first of all, I'm not real hung up on counting exactly the maturity dates in this class. It would be, if the note was March 1, well, that would be what? April, May, June. I don't care if you said June 1st or if it's actually May 31st, okay? It's 90 days out. That's the main thing. How much interest is involved and it will have to be repaid? Well, the principal of the note is $12,000, right? Correct? The annual interest rate is 9%. Now we have to do this thing that students sometimes forget, but this is not complete by just saying 9% times 12,000, because this is only a 90-day note. So we take 90 divided by 360, or you could do it divided by 365, since there's 365 days in a year. But oftentimes we'll just use 360 because the math is always a lot cleaner. Either way, I don't care what you do, you're going to get roughly the same number. But in this case, the total interest that's due is $270. Do you get that? So, when this person pays back this loan, they're going to have to pay $12,000 plus $270. So a total of $12,270, right? How will that journal entry look? Well, when we issued the note, this was it. And this was a situation when we just made a sale and it was on a formal notes receivable. When it's repaid on May the 30th, like I said, they had to give us a total of $12,270 for the principal plus the interest. Of that 12,270, we have to reduce notes receivable by 12,000, right? But the other 270 of that is interest revenue. So this is our journal entry here. Do you understand that? We get a total of 12,270 from this customer. 12,000 of that is for principal, and we reduce our notes receivable by the principal reduction. But the other 270 is interest revenue, or interest earned, you might say. Okay? Now, what if they dishonor the note? That means they don't pay it. Well, then we're still going to record this credit side of the journal entry, but we're going to set it up as accounts receivable because they still owe us, right? And we're going to pay them a little visit, aren't we? We're going to go to their house. If there's a family pet, that pet could be in danger. No, I'm just kidding. No, but we're going to give them a phone call, and we're going to say, hey, you had a notes receivable with us, or you made a note to us, and you didn't pay it. So they have to pay it now, don't they? So we have to work on that collection. Any questions on that? Okay. Now we're not going to get entirely through the rest of this, but just let me touch on something real quick. Sometimes we're going to have an end of the year adjustment that is necessary, even though the note isn't due, but we have to show the amount of interest earned by the balance sheet date or the end of the year date. We did this in chapter 3. Remember adjusting journal entries? So when a notes receivable is outstanding and it's not going to be paid, we have to accrue the interest income. And we use it mainly doing the same thing. Here's an example. On December 1 of 2012, Matrix Inc. purchased a copier for $12,000 from Office Supplies, issued a 99% note due in 90 days in payment for the copier. Now here, this 90 days is after December 31 of 2012, which is when we do our balance sheet, right? So we have to accrue 30 days worth of interest. We have to accrue 30 days worth of interest. They're not going to pay us any principal, and they're not going to pay us any interest. But we do need to show at December 31 that we have 90 days of revenue that are earned, and we need to show that as interest receivable. You with me? Because that could be a significant amount for some companies. We need to show that asset. We need to show that revenue. Okay? Now, I'm going to stop there, but I ask that you read the rest of your book, of your chapter in regards to notes receivable. Okay? And because I'm going to assign some homework in regards to it. Oh, let me see what I want you to do for homework. Let me write this down, and I will put it up there, and then we will be done. Okay, now I also want you to read, you know how they have a ratio at the end, guys? You know how they have a ratio at the end? I want you to read about the accounts receivable turnover ratio. That's the ratio at the end of this chapter, okay? And because you're going to have a homework one in regards to that. So what I want you to do for homework is these exercises right here. Okay? But you will need to read the rest of your chapter in regards to notes receivable, and you will need to read the section on the accounts receivable turnover, and that is on pages 375 and 376. As a matter of fact, let me just make this more specific. I know you want to go here. Just hold on. Just read pages 370 through 376 before you do any of these exercises, and then you'll be covered. You with me? All right, we'll see you guys. Bye-bye.